Welcome to this explainer. Today, we're diving straight into the cold, hard reality of why your perfectly good technical trading strategy might currently be turning into a slow motion liquidation. If you've been active in the markets lately, you've probably been scratching your head, right? Wondering why your carefully calculated risks are just slowly bleeding out. Well, we're going to unpack the predatory math of strategic overtrading and expose exactly why excessive activity is literally the fastest way to destroy a portfolio right now. Picture this, because I know a lot of us have been there. It's an agonizing frustration. You execute winning setups, your technical analysis is spot on, and yet when you look at your account balance, it's just steadily dropping. I want you to realize something right out of the gate. It's not your technical analysis that's failing you. The actual culprits are these silent killers lurking in the mechanics of the market itself, transaction fees and slippage. Even if every single trade you take is a winner on paper, hyperactive execution transforms your capital into a crime scene, and you won't even see the damage until it's already done. I really want to emphasize this number because it's the ultimate trap: 70%. A 70% win rate sounds like the absolute holy grail of trading, doesn't it? But that metric is completely meaningless when hyperactive execution gets involved. The reality we're unpacking today proves that even the most elite, perfectly back-tested strategies cannot survive the crushing weight of excessive market friction. A high win rate simply cannot outrun a hyperactive trigger finger. Let's move into Section 1, the invisible trading tax, mechanics of 2026. To really understand why this bleeding happens, we have to look at the structural market forces at play. The ultimate predator in this ecosystem is something called the spread tax. Now, this isn't a tax you pay to the government. It's the reality where every single additional click and transaction actively increases the statistical probability of your portfolio decaying. The market structure literally penalizes you just for participating. The more you trade, the more you pay for the sheer privilege of being in the arena. And when you break down the math behind these hidden costs, it is staggering. Take ECN fees, for example. These are essentially the toll booths of the market. Combined with high-frequency trading rebates, these structural costs are quietly eating up to 30% of your winning margins. 30%! And if you're trading mid-cap assets in highly volatile environments, the slippage you experience is effectively turning a really favorable 2-to-1 reward ratio into a break-even trap. You might think you're capturing all this alpha, but the structural friction is actively consuming it right under your nose. Which brings us to Section 2. Hijacked by dopamine, biological sabotage. So market friction is bad, but it wouldn't actually matter if we weren't compelled to interact with it so often. We need to be brutally honest here. Who is really pushing the buy button? Is it the rational strategic trader who spent 3 hours charting the asset? Or is it a chemical imbalance overriding your calculated risks? The urge to just do something is probably one of the most destructive forces in trading. Your brain is literally wired to sabotage your portfolio just for a quick hit of dopamine, turning incredibly disciplined setups into massive, expensive mistakes. You see, the modern 24/7 market cycle is entirely weaponized against your biology. Look at the trading apps we use today. They are packed with gamified UI elements designed specifically to trigger compulsive execution, especially during those low-probability, choppy windows when you really should just be sitting on your hands. You go through this physiological shift from strategic analysis straight into reactive clicking. It's driven entirely by the fear of missing the next tiny microtrend. Ultimately, your brain starts prioritizing the instant gratification of just being in a trade over the delayed reward of waiting for a high-conviction setup. All right, moving into Section 3, signal pollution, strategy decay. This biological hijacking we just talked about leads directly to a physical distortion of how you see the market. Think about a solid 65% win rate setup. That's a great technical strategy, but it will completely fail when it's forced into hyperactive timeframes it was never designed for. The validity of any strategy is deeply tied to its intended execution frequency. When you force a daily swing strategy onto a 1-minute chart just because you're bored, well, you aren't trading your strategy anymore. You're just clicking buttons. We actually call this dangerous distortion signal pollution. It's your brain playing tricks on you, making you see ghosts on the chart. You start identifying these patterns that simply do not exist, purely because you are desperately looking for a reason to justify that next trade and stay active. You're polluting your own data feed with noise generated entirely by your own patience. And the visual backtest data on this is just wild. It proves the distortion perfectly. When you take a hyperactive strategy and you simply cut the trade frequency in half, you literally double the net profit. Actually, think about that for a second. Half the work, double the return.
It proves beyond a shadow of a doubt that excessive activity is mathematically diluting your edge.
Let's look at who benefits from this in Section 4, Feeding Predators Institutional Edge. So where does all that lost capital actually go? Welcome to the dark reality of order flow. When you overtrade, you get flagged by AI-driven market makers as a noise trader. Your dopamine-fueled overtrading isn't just hurting your own account, it's actively providing the necessary exit liquidity for massive institutional algorithms. They rely on your compulsive need to click the buy button so they can safely exit their giant positions at your expense. Every time you overtrade, you are willingly feeding the institutional predators. So, what's your best defense? You have to realize that doing absolutely nothing is not a weakness. Staying sidelined is a heavily armored, highly tactical position against predatory AI. When you sit on your hands, you are actively preserving both the mental and financial capital that you are going to desperately need when a true high-impact opportunity finally shows up. Let's wrap this up with our solution in Section 5, Predator Mindset, High Conviction. It is time to flip the script and become the hunter rather than the hunted. Just look at the contrast here. On one side, you have the chaotic, bleeding retail approach, the reactive mindset. This is the trader staring endlessly at live candles, falling victim to gamified UI, constantly chasing instant gratification. But on the other side, you have the cold, calculated edge of the predator mindset. This trader stays patiently on the sidelines, relies on automated alerts to tell them exactly when to act, and executes only on absolute high-conviction setups. So how do we build this predator mindset? You need a high-conviction execution framework. Step 1, put a hard cap on your daily transactions. Just force a strict hierarchy in your watch list. Quality over quantity always. Step 2, transition away from the screen by setting automated alerts. Seriously, stop staring at live candles and let the market come to you. Step 3, completely redefine your metrics. Start measuring your success by how many unforced errors you reduce and how well you preserve your capital during choppy, non-trending regimes. This framework is your absolute best shield against that slow-motion liquidation. I want to leave you with a bit of a contrarian warning that shatters a massive myth in the trading world. Most traders fundamentally believe that more activity equals more profit. They equate sitting at the desk, rapidly clicking buttons, with working hard. But right now, overtrading is without a doubt the fastest way to kill a perfectly healthy portfolio. Doing absolutely nothing, preserving your capital, and just waiting for that perfect pitch, that might literally be the most profitable move you make today. So, the very next time you find your finger hovering over that buy button, I want you to ask yourself a hard question. Are you actually trading to make money, or are you just paying a massive fee for your next dopamine fit? Master the math, control the biology, and protect your capital. Thanks so much for joining me on this explainer.